Good afternoon, ladies and gentlemen. Welcome to today's presentation. My name is Devin Ekberg. I am Chief Learning Officer, Managing Director of Professional Development here at the Investments and Wealth Institute. Today's presentation is really mostly about the SEMA certification and really more about adding value for your investment management clients. So over the next 30 minutes or so, my goal is to really give you some things to think about. There are some trends going on in the investment management space that you're probably very well aware of. I'd like to share with you how we think about those trends here at the Institute and how our SEMA certification really attempts to address some of those trends and some of those issues that you are facing in your own practices and in your own careers. So hopefully, again, over the next 30 minutes or so, I give you a couple of things to think about. I give you a couple of methods to address some of the issues that are going on, and also just kind of give you some information about whether the SEMA certification and your pursuit of a certification makes sense for you and whether it would be relevant to you and your clients. So I'm going to go ahead and jump in. Now, if you're not familiar with us as an organization, the Investments and Wealth Institute, we're a professional association. We're best known for the certifications that we administer, which are CIMA, as you know, Certified Investment Management Analyst. We also administer the Certified Private Wealth Advisor, CPWA. That's for folks who are managing individual clients like high net worth, ultra high net worth type individuals and families. And also a relatively new credential that we just acquired, the RMA, the Retirement Management Advisor. And those are the three certifications, designations, credentials that we administer. Now, we're also an advanced education provider. So we work with university partners like Yale and the Wharton School of Business at University of Pennsylvania, the University of Chicago. These are top 25 business schools, and we work very closely with their faculty in developing curriculum, making sure that it's academically and researched and validated from a research perspective. But also, we make it practical, and that's very important for us so that you can walk away with something that you can incorporate into your practices today and add immediate value to you and your clients. And so for me personally, I'm actually very proud to be associated with an organization like the Investments and Wealth Institute. I think we do it the right way, and we hope that we can add value to you and to your clients throughout your entire career as a member of the Institute. And what that's really all about is adding value to your clients in such a way that you distinguish yourself as an advisor, as a consultant, as a professional, amongst all of the individuals that are out there, so that your client understands what value you're adding for them, and that most importantly, they differentiate you as their advisor and can basically define what your value proposition is. Now, again, that's great for the client, and it's great for you. Those clients tend to be stickier. They tend to retain more assets with you. They tend to refer more individuals to you for business. But it's also better for them in terms of creating better financial outcomes over time, and that's really what everything is all about for us. So as you think about ways to differentiate yourself as an advisor or consultant or professional in this space, really understanding the knowledge and skills and abilities that you need to have to operate in that is super crucial. So I just kind of want to start out by really identifying some trends that we're thinking about in the investment management space. And again, you're probably familiar with these already, but I just want to share the way we're thinking about it. And I'm not going to address each of these individually, but certainly the debate between active management and passive management, you've seen some of the if you work for a firm, that's an asset manager, you've seen some of the consequences of some of the move towards passive investing and so forth. The increased competition that's out there, not just a competition of resources, but a competition of ideas, a competition of execution. There's tons of ways that people are competing with you, and these are the smartest people in the world that you're competing against, and that's a difficult challenge to take on. Changing market environments. We hear the word the new normal all the time, right? And we've heard that in a lot of ways. A new normal when it comes to, political and geopolitical risk. New normal when it comes to interest rate policies. New normal when it comes to central bank policies and interventions in the markets and so forth. These are changing market conditions that your clients don't understand, and you have a significant opportunity to add value in helping your clients digest what those changes mean and ultimately how to respond to those changes. I put big data on there as a big trend of investment management, and you could actually look at it in a couple of different ways, and I'll speak to that here in a second. I put smart beta on there as well. You could maybe even more broadly just kind of say factor investing is certainly a trend that I don't think is going away, and certainly there are ways that you can add value from a factor-based investing perspective. The access to private markets is changing for your clients, not just your institutional clients, by the way. I'm not just talking about pensions and endowments and foundations. I'm talking about individuals as well who now have more access to private markets than they've ever had in the past, and that's a significant way to add value as well. And then, of course, we all know that that fees are compressing, and that's probably actually going to be a new normal. And there are certainly ways that you can address that, but more importantly, ways that you can add value in such a way that your clients understand the fees that they're paying you and are comfortable with those fees. We found, according to our research, that clients are okay paying higher fees, but you have to justify those fees somehow. So those are kind of the trends that I want you to think about. Now, this kind of basically displays what the debate between passive and active investing is. In the last 10 years or so, the amount of money of equity flows into ETFs and mutual funds that are actively managed has basically fallen off a cliff, and that money has basically flowed right into passive investing funds. That's not a secret. And then on the right-hand side, those exchange-traded products that are receiving those assets have just grown exponentially over the last 10 years as well. And quite frankly, I see those trends continuing. I don't see what the catalyst is for those trends to change. Now, that doesn't mean that they can't change. In fact, the next slide that I have here sort of indicates a little bit that this whole idea of active and passive investing really operates mostly in cycles. So in the previous slide, I showed you the last 10 years of those equity flows between passive and active vehicles. But in this chart, the last 10 years is really only the right-hand part of that chart. And certainly you can see the percentage of funds that are outperforming the S&P 500 in these rolling 5-year periods has ultimately shown what you would expect given those flows into passive funds. But if you look at it as a longer time frame and look at it as a cycle, there are periods of time similar to what we're experiencing today where those trends have changed. And simply put, active funds may very well become in favor again from a cyclical perspective. Now, I'm not advocating that you move away from passive investing into active investing, and I'm certainly not mentioning or saying that the SEMA certification is only for active managers. But I want you to get that perspective because you're going to hear it from all over the place that the new normal is passive investing, and we certainly have evidence to say that it's persistent, but I'm not convinced necessarily that it's not cyclical. And so this chart's just an interesting way to kind of tell that story. By the way, your clients are asking questions about this as well. They are fee conscious, and certainly that pushes them towards passive investing, but there are opportunities, I think, to explain this to your clients. And when you think about passive and active investing, I think it's important to understand what your investment returns are doing. And so I kind of put this chart up here to kind of decompose what your investment returns are. At the very top of the chart, you've got your investment return, and broadly speaking, you can divide that into two areas, right? Your cap-weighted index benchmark return, like the S&P 500, if that's what your benchmark is. I read an article, I think yesterday or the day before, where there's like 3 million indexes out there in existence today. Pick one, and that's your benchmark. Okay, pick one out of 3 million. S&P 500 sounds pretty good for this example. And then what you've got is your active return. In other words, if you're making decisions outside of the composition of the S&P 500, whether you're trying to time the sell or purchase of securities or choosing alternative securities, you're seeking an active return as you deviate away from that benchmark return. And if you just decompose what your active return is comprised of, that return could come from exposures to factors like smart beta factors, like momentum, value, size, quality, that sort of thing. And then basically the pure alpha return, which is the value that you're adding as a manager to that benchmark based on your decision-making process. And there's a lot of different decision-making processes, right? You can go from a bottom-up process, like you're analyzing individual securities, doing discounted cash flow models on individual stocks and bonds and other things like that. Or you can go more from a top-down approach. You're really kind of maybe more looking at macroeconomics, maybe industries and sectors, rotating in and out of favor and so forth from a top-down, or maybe looking at timing factors as well. Does that make sense? So that's kind of how we think about the composition of the investment returns. Where you really need to think of is what type of exposure you're trying to create for your client, and what your client is needing and desiring. So if all your client is needing and desiring is just exposure to those cap-weighted index benchmark returns, well, those index funds are cheap and they're plentiful and they're great. They do that perfectly, and that may very well comprise the core of what your your individual investors or institutions are looking to achieve. Another way that you could look at it is really looking at it from a factor-type based approach, where you're maybe using indexes, but also trying to craft them in a certain way that you're gaining exposure to the underlying factors amongst what the constituents of those indexes. So kind of more of a smart beta type approach. And finally, you may take an active management approach where you're making decisions on each of these levels to decide what the appropriate exposure is, what the appropriate vehicle is, at what time that exposure should be implemented or taken off. And quite frankly, you make those decisions every day. And quite frankly, also, this is probably the reason you got into this business in the first place, is this is what drew you to investment management as a profession, was being able to kind of make those decisions and add value to your clients. And this is not going to go away. You're making those active decisions every day. So your clients are expecting and demanding competency in making these decisions of when, where, how, and why to implement these different strategies to your individual clients. And certainly there are a lot of smart people out there doing this, and this is table stakes at this point. In other words, if you're not doing this for your clients already, you may end up having a problem. And certainly you'll have a problem differentiating yourself between other advisors and so forth. But there are ways that you need to add value beyond simply the investment management approach. Now, I want to kind of switch gears here and talk a little bit about big data. I mentioned that as one of our disruptive trends. And you can actually look at it from a negative perspective. A lot of people look at robo-advisors and say, oh, well, big data, robo-advice, it's going to replace what we do. Computers are going to replace ultimately what investment managers do. Well, that could be true. The trends we're seeing more now is that technology is augmenting what advisors have traditionally done and allow them to do it in a better way. And big data, I think personally, is actually a useful item for you. You can get data that tells a different story than what we've been able to do in the past ever before. So beyond just the financial data that we have access to now because of these data resources, we've seen that the availability now is so vast of data that it's just access to it is no longer sufficient. It's not a differentiator to say that you have access to this data. Now what the edge is that you're identifying which data is useful, and in analyzing and effectively processing that data in a way that's useful and adds value to your client. So certainly, as we've looked at the SEMA certification over the years, and we do our job task analysis over the years, this conversation gets bigger and bigger in terms of how to use technology, how to use data to add value, and analyzing and effectively how to process that data. And that's a big part of the body of knowledge for the SEMA certification program. Now, I also mentioned private equity and access to private equity, and we've seen studies that suggest that, well, not only are endowments and foundations, most famously the Yale endowment, which is like a $132 billion endowment, is like in 70% private equity securities. Individuals are now demanding access to this. And just kind of looking at the right-hand side of this chart, like venture capital, private equity, real assets like real estate and other things like that. We need vehicles in order to invest in this, and we need real competency of advisors to advise clients in how to gain access to these. And so I think that's an underrated area of expertise that is going to grow bigger and bigger, and areas in the investment management space that if you become an expert at and ultimately provide that access to your clients in this space, that's a way that's going to differentiate you from others. And again, the SEMA Certification program has identified these private equity securities and constructing portfolios with private securities as a huge focus in the curriculum. And quite frankly, for good reason. The private market is much bigger than the public market, if you think about it in those terms. Almost $5.5 trillion now in 2019 U.S. dollars of private market assets, and that's all over the place: North America, Europe, Asia, the rest of the world, all sorts of different areas out there. And if you think in terms of goals-based investing, which is sort of a trend that I think people are moving towards, where it's not just pure investment return people are looking at, they're looking to meet individual goals based on those returns. There's tons of opportunities out there to create income. For instance, here on the left-hand side of the chart here, used to traditionally just be a mix of bonds and stocks that created income. Now there's all sorts of private credit, leveraged loans, MLPs, farmlands, business development companies, things like that. If your goal is more risk reduction, bonds used to be the answer, but now there's really more kind of a hedge strategies, like long-short strategies from hedge funds, managed futures, options, other things, arbitrage strategies, things like that. If you're really looking to enhance those returns, again, traditionally it was stocks, but now you look at private equity growth companies, or energy companies, buyout companies, other type of ventures that you're looking at. And if you're just simply looking to, keep up with inflation, and that's the purpose of consulting with an endowment, for instance, there's tons of ways to add value there. And if you look at the vehicles down below here that you have access to, passive investing is really just kind of a portion of that. The rest is really requires more of that active management and really requires more of an expertise to implement. So tons of opportunities out there for the people that have the right knowledge and the right skills. So I want to kind of quickly tell a story, and then I'll finally kind of talk about the certification program itself. But I've got a friend of mine that's a locksmith. He's been in the business for 30 years. He has seen every single lock that you could possibly imagine: cars, homes, safes, other things like that. He used to carry around a big toolbox with him, but he got to the point where he could literally just walk up to a door and open it with a small tool in his hand. Take him 30 seconds. He's learned that much to be able to do it. What he actually found was that when he'd go up to somebody that was in distress, trying to get into their home, trying to open this lock, he'd walk up and open the door in 30 seconds using this small tool in his hand. And when he went to collect his fee, let's say it's $500, the client would kind of raise their eyebrows a little bit and think, well, wait a minute. Why are you charging me $500? It took you 30 seconds to open this. I don't see the value here. And what happened is that they didn't necessarily see all the 30 years worth of experience. They didn't see all the classes that he took, all the tools, all the bruised fingers that he had over the years trying to figure out how these locks worked and so forth. They didn't necessarily understand his value. Now, he had to demonstrate his value somehow. I don't recommend you doing it this way, but he, sort of doing it in a destructive way. He started just kind of taking longer on his jobs. Instead of 30 seconds, he'd take, 30 minutes, or he'd break the lock, or he'd struggle with it, or he'd bring this huge toolbox to kind of show people that it was harder than it really was. And interestingly, even taking longer on the jobs and breaking the locks, people were happy to pay the $500 fee. Because they saw, or they at least felt, the value that he was adding to them at that time. Now, think about that from your perspective as an investment consultant or investment advisor. Your clients don't necessarily understand all the effort that you've put in, all the hours of study, all of the the bruises that you've probably taken in the markets, at times. They just simply don't understand that. So it's really up to you to communicate your value as an advisor, and they want to know what your certifications are. They want to know, if you hold a CIMA, what does that mean to me? How does this help you service me in better ways? And they want to understand this stuff. So let me kind of move on and just really talk about the CIMA certification if we can. What we've found in our research is that CIMA certificates typically have higher average earnings than a typical advisor. They manage more assets. They typically have a higher client wallet share. So we've sort of stood out among other financial certifications for basically emphasis on the combination of theory and practical application, which has unique benefits not only to the client but to the advisor as well. So we position CIMA as the peak international technical portfolio construction program for investment consultants, analysts, financial advisors, wealth management professionals. Now, I'm just going to add to this that CIMA is really designed for those folks that are client-facing, not even retail investors. I'm saying client-facing in terms of institutions, individuals, families, other things like that, because it's built in a way that's very practical and useful for people to understand and buy into. And typically it's for those folks that are constructing portfolios at a fund level, not necessarily getting down into a security level, which many of you may do and have some expertise in, but that's not really where CIMA is. It's really much more at the fund level and really understanding those best practices in constructing portfolios in a way that your clients understand, that they can stick to, and that they can be satisfied with, but that also meet their longer-term goals. Now, if you take a second to just kind of analyze where CIMA fits into the landscape of other credentials that are out there, CFP is really more, I think, probably for financial planners. These are folks that are working with individuals, typically retail investors. They may be wealthy or not, maybe more affluent, mass affluent type individuals. But it's really more kind of planning, maybe from an insurance perspective, taxes, estate planning, that might get into some of that. CPWA, which is one of our other credentials, is really more, it's kind of a post-CFP experience and designed mostly for high net worth and ultra high net worth individuals. So you're going to get into very advanced wealth management strategies for asset protection, tax and estate planning, legacy planning. Typically for folks that have $5 to $10 million or above is where CPWA really lives. So CFP and CPWA, I don't think are real direct competitors to CIMA or CFA, but really more kind of wealth management and planning credentials. Where you really want to kind of make the distinction is, should I pursue for investment management, should I pursue CIMA or CFA? And I have both. I have both the CIMA and the CFA, and so I can kind of explain a little bit of the difference. CFA is much broader. It takes 3 years as a typical time commitment, most likely longer because those exams are extremely difficult. It's mostly a self-study program, and it's very broad. You're dealing with individual security analysis, accounting. I recall having to teach myself accounting. That was not my expertise at the time, but you really had to have an accounting background to understand some of the individual security analysis stuff. The corporate finance, it really gets very broad. Portfolio management is very complex within the CFA, and for good reason. It's really designed for those folks that are behind the scenes constructing portfolios, but not necessarily dealing with clients. And I can say that kind of in a funny way. When you speak to a typical CFA charter holder, they're not the guys that are out there talking to clients and helping them understand what their portfolios are doing, because they tend to go much deeper and way too complex for the typical client to even understand, even very sophisticated clients. So where I found the value in CIMA was really understanding investment management, portfolio construction, best practices from a perspective of how the client thinks about it, and a way to communicate effectively what you're trying to accomplish and how you're trying to accomplish in a way that they can understand and buy into and ultimately have confidence in. So I found that to be an extremely important distinction between CFA and SEMA. I also found that the education component to SEMA, I happened to go through the Wharton School at the time, but University of Chicago and Yale are certainly comparable. I found that education piece to be absolutely valuable in the pursuit of the SEMA certification. Certainly, it's the typical time commitment is much less. It's about 9 months or so. You go through a self-study period. I'll go into that in a second. There's only one exam to take as opposed to 3 exams. And, I wouldn't say that the exam is easier than the CFA, but it's certainly more, I think, applicable to the day-to-day work that you tend to do as you're working with clients. In other words, they're probably not going to ask you to calculate, fixed income convexity curves by hand, really making it more of a math exam than, conceptually understanding how convexity works in a fixed income environment. So that's the difference, I think, between the SEMA and the CFA. Now, when you go and ultimately pursue your SEMA, you do have to follow the 3 E's that we talk about: experience, ethics, education, and the exam. You need to have 3 years of relevant experience in the financial services industry before you begin the program. They do a background check. You'll need to disclose any issues that you might have from an ethics perspective, and they do have you follow our Investments in Wealth Institute Code of Professional Responsibility. There's an education piece to it, not only a self-education, but also through one of our registered education providers, I'll go into in a second. And then, of course, you must take an exam and pass it, and it's administered at a third-party testing center. Pearson VUE is our partner on that. The core topics of the SEMA curriculum are pretty straightforward. One note that I'll have is that we use a process in the certification process. It's called a job task analysis, JTA. And it's basically an enormous survey that goes out to individuals like you who are, in the trenches, if you will. And they tell us what are the skills and what are the knowledge and what are the abilities that advisors need to serve their clients competently. And so based on the results of those surveys, our body of knowledge focuses on, the high priority elements, but it also develops over time as the markets change as well. So you can kind of see here, and I would urge you to check out the website to get a deeper look into the body of knowledge. But quite frankly, you're looking at different styles of investment management, different theories, basically an entire framework to understand what type of strategy might be most useful for your client at the right time, at the right place. And then ultimately, what's the best way to construct those portfolios? And so the consulting process, the construction process, and ultimately how to get the most value for the cheapest buck, I suppose, for your clients. And then ultimately managing risk and return and monitoring the results over time. So the entire consulting process is a big, big focus of the SEMA program. This is kind of how the exam weighs out in terms of the different domains and sections and what it is tested. You can see kind of down at the bottom, the portfolio construction and consulting process is the biggest element of it, 25%. But some of the other areas there about investments, risk and return, portfolio theories, and so forth really comprise the majority of the exam for you. The process that you're going to follow to become SEMA certified is pretty straightforward. There's really 3 steps. Oh, and there was a question that came in that I want to actually ask here. The question was, is the exam really more conceptual in nature, or will it require heavy use of a calculator? Can you please describe what percentage of the exam will require the calculator? I'm going to take it. I'm just going to take a personal guess here. I don't know what's on the exam. I took the exam 2 years ago, so I can kind of speak to the exam that I took 2 years ago. I would estimate that about 50% of the exam did require some calculations at some point. Okay, some of them very easy that I just used the calculator because it was convenient. I probably could have done the math in my head, but certainly there were elements that I needed the calculator to do: time value of money calculations, compounded growth calculations, calculating the standard deviation of certain assets given certain inputs and so forth. Now, they do give you a formula sheet that you can follow. As long as you know how the formulas work, you'll be given the formula sheet during the exam, so you don't have to memorize formulas like you do in the CFA program, so that may be a little bit more comforting to you, but certainly you'll require a calculator. And then I would estimate that the other 50% of the questions really were conceptual in nature, some of them very simple, but some of them, with a lot of moving parts. So it's a challenging exam. It'll definitely challenge your knowledge in terms of the technical aspects of portfolio construction, but also the conceptual as well. I hope that answered your question okay. Now, the 3 steps that I was talking about is the first is really your self-study period of the SEMA body of knowledge, and we do give you direction on what readings and other things like that are available for you to read. I would recommend about 150 hours. Depending on your level of experience, you may do less than that, may do more than that, but that's sort of kind of a recommendation there. In our Candidate Resource Center, we give you access to quizzes and activities and formula worksheets and other things like that. You're really kind of spending your time getting familiar with the concepts and the calculations and other things like that. The next step is to go through the executive education program. Now, there's different flavors of this that I'll get into in here in just a second, but it's basically an executive education experience. I told you about my experience at Wharton, and what stood out to me is that the core professors at that executive education program at Wharton, for instance, are the same professors that were there 30 years ago when this program started. I'm talking about Dick Marston and Jeff Jaffe and Craig McKinley. 30 plus years of experience between or among all of them. That's like 100 years worth of experience in those professors teaching over a 5-day period. I got an extreme level of value there. The University of Chicago is fantastic as well. It's a little bit different style, different format. They actually have a little bit of a hybrid program that you can explore as well. But University of Chicago is really more known as kind of more of a research type school. They've got Nobel Prize winners coming out of University of Chicago all the time. A little bit different type of experience, but very powerful. We also use Yale as our registered education provider, and Yale almost doesn't even need an introduction. They're there, and they're their professors and the way that they do things is the reason that they're an Ivy League school. So the point is that the education program is critical in terms of solidifying what those concepts are for you and bringing in those academic professors to really hit it home for you, but also bringing in those real-world practitioners to help you walk away with it and say, wow, I can actually implement this today with what I've learned. There's also huge networking opportunities and opportunities to literally discuss these things with your professors in Q&A environments and things like that. So that's a very, I think, valuable and certainly worth the price of admission, and quite frankly accounts for the bulk of the admission price is your access to these university partners. And then finally, once you're done and you feel like you're ready to take the exam, it's a computer-based exam at a local testing center. There's 140 multiple choice questions, 5 hours to complete those questions. And one of the questions that came in is somebody pointed out that there are 15 of those 140 questions that are kind of mixed throughout the exam, but that are not graded. Those are kind of testing questions that may show up in the future as being tested in a future exam. Okay, so what I wanted to really briefly kind of talk, I kind of told you a little bit about the experience of these different schools. The Wharton is the 5 days where you're literally on campus for 5 days. The Yale program is actually all online. And so you really those are the two kind of extreme experiences. All day, all week on campus, or all online. And it really kind of depends on what your learning style is. We've heard great feedback from both formats. So if you're really more of an online learner, Yale is great. If you're more of an in-person, on-campus type learner, Wharton is fantastic. I would be proud to hang that certificate on my wall no matter what. The University of Chicago is similar as well, but they're a little bit of a hybrid program. Theirs is a 2-day on-campus program, the rest online. So you kind of have a lot of different choices depending on what your learning style is. One question that came in, Victoria says, I'm not a financial advisor, but a financial writer, and I'm considering the program to gain more education. What's your opinion on that? I think that's a fantastic idea, and let me tell you why. It's because, as a writer or a journalist or a salesperson, or if you're just kind of tangentially involved in the financial industry, what the SEMA program does is it gives you the language that you need. It gives you the language not only, Victoria, I think if you're writing about a financial topic, you'll have the language to express yourself, but it'll actually give you the language to speak to other professionals, other subject matter experts, other advisors. If you're interviewing folks about a topic, they're going to understand and feel comfortable giving you their best answer if they feel confident that you're going to understand their best answer. So it gives you that language. We have salespeople coming through all the time. So one of the constituents that we serve in the industry is the wholesaler community, and wholesalers, their profession is mostly sales, but they're literally talking to advisors and professionals from all over the country and high levels within organizations, and they're selling financial products, but they need to understand what those financial products do and how they work and how they fit into a client's portfolio, and they need to have better conversations with those advisors. And we don't look at it as a sales tool, but really more as a communication tool for them. And it creates a better outcome not only for the wholesaler because they're better able to describe the products that they're selling, but it's a better outcome for the advisor as well because many of those products were perfectly designed for what the advisor is looking for. And we've enhanced the level of communication from a financial industry perspective, and we're really proud of that. So I would guess that as a writer or as maybe as a service professional or as a product professional, all of those, I think those types of people will benefit from going through a program like this. So I hope that answered your question as well. So I just want to kind of end here. I'm certainly happy to answer any questions. We've gone over time just by a couple of minutes, but I'm happy to answer any questions in terms of what your experience is or what your expectations have been. I would also invite you to reach out to our staff. We're happy to really have a conversation or a dialogue with you about whether this certification makes sense for you, even if it doesn't make sense for you today, but perhaps in the future as part of your career path. If you intend in the future in the next 2 to 3 years to be constructing portfolios for your clients, we would recommend that you look at the SEMA program today as a way to prepare yourself for your eventual career path. We'd also like to discuss who your clients are and whether they could benefit from some of the knowledge and abilities that are available in this program. But what I wanted you to really walk away with today is thinking of those 7 trends I was talking about, right? The whole conversation between active and passive, the whole changing market environments, the whole idea that, data and analytics and how important those are becoming in our day-to-day decision-making processes. The ability to add smart beta, for instance, or private equity securities into portfolios. If any of those things feel like a trend that is relevant to you, I would strongly consider the SEMA program as a way to enhance your knowledge and skills around those areas, because I just don't think those trends are going to go away. And at the very least, you can take advantage of those trends over the next 2 decades to add value to your clients. So I'll kind of leave it at that. I don't see any other questions kind of popping in here otherwise, and if I've missed a question, I apologize for that. But I'd like to invite you to reach out to Susan Baber. She's our Associate Marketing Director for the SEMA program and all of our certifications. And she's also a former financial advisor herself. She has her CFP, she has her RMA, she's very knowledgeable, and she can have those conversations with you. So I'm going to go ahead and wrap this up before I lose my voice here. Thank you for all your time. Thank you for the time that you spent discussing these with me today. And feel free to also reach out to me personally, and I'm happy to have those conversations with you as well. And I hope to catch you on the next class at Wharton, Chicago, or Yale. And we'll catch you then. Thanks a lot.